Okay, so this video is called Beware of Those Perfect Equity Curves. In this video, we're going to show why equity curves can be very deceiving and begin by showing why the start date can be like putting lipstick on a pig. We'll then show a real-life example of a top-performing fund, and we'll end by showing some better ways to measure performance. So let's start by showing a hypothetical strategy example with two simple rules. Rule number one, when the market is down, the hypothetical strategy will beat the market by 20%. And rule number two, when the market is up, the hypothetical strategy will underperform the market by 5%. And we implement the strategy starting at the beginning of the year 2000, and this is what the performance looks like for the strategy and the SPY benchmark. You can see the annual returns for each strategy, and on the right hand side, each strategy starts out with $10,000, and you can see how their equity builds up all the way through the end of 2015. The SPY ends with a total equity value of $19,900, and the hypothetical does a whole lot better, ending up with $28,800, beating the SPY by 44%. So that was starting at the beginning of the year 2000, and the hypothetical strategy looks pretty good. This shows what the equity curves look like, and you can see the hypothetical in red is a solid outperformer from start to finish. It looks great, consistent outperformance all the way through. Now, what we're going to do is change the start date. Instead of starting at the end of 1999, we're going to start it at the end of 2002. And unfortunately, it does not look so good anymore because now the hypothetical strategy essentially underperforms for the entire period. So lesson number one is that the start date can be very deceptive about the total performance of the fund. Simply shifting the strategy start date forward by 3 years turned a nice outperforming strategy into an underperformer. The better way to look at performance is on a year-by-year basis in a side-by-side bar chart like you see here. This provides a better sense of how the strategy performed on a year-by-year basis and whether there were one or two outlier years that are having an outsized impact on the total performance. And so given that absolute performance is very dependent on the start date, look at the consistency of outperformance on a year-by-year basis rather than in an equity curve which disguises the year-by-year performance. Now let's look at a real-life example. So I googled top-performing mutual funds and got something from Kiplinger, and they rank funds by different time periods. This was their list for best-performing large company stock funds over a 20-year period. Kiplinger does provide the 1, 3, 5, and 10-year performance, which is good since I could tell just by looking at the second one that it was going to be a good example of the start date dilemma. Sometimes you may see promotional literature that does not provide this level of detail or where the start date of performance reporting has been selected to suit the fund promoter. So when you look at their 20-year performance chart versus their two benchmarks, it matched both of those up until 1999, and then it just took off, and since then it looks like a solid performer. If we look a little closer, we can see that 17 years ago they had an unusually good 2-year stretch. Those 2 years really elevated them, but from that point forward, it's hard to tell how they compare to the benchmarks through the end of the period. If you look at the 10-year chart, you can see they slightly underperform over the past 10 years, and the 5-year chart is a little bit worse. They underperform by more. It's not terrible underperformance, but it's not the big winner like we anticipated given their rank as number 2 on the list. So let's dig a little deeper, download the data, and tabulate the returns for each strategy by year and see what's going on. What I like to look at is the average annual returns, not the compound returns. It gives a more balanced view of performance. So we look at average returns, the standard deviation, the reward to risk, and compare how the strategy does in years when the market is down and years when the market is up. And the strategy does outperform by 2.5% per year, but with more volatility, 26.2% versus 18.8%. On a risk-adjusted basis, the SPY actually does better. The strategy outperforms by 1.26% when the market is up and outperforms by 8.16% when the market is down. So that's pretty good. So it doesn't look too bad. We understand what it is. It does outperform, but it is doing so with more volatility or risk than the benchmark. But now let's see what happens if we exclude those 2 great years from 17 years ago. So we've taken those out and recalculated the averages. And now the strategy actually trails by 2.11% per year on average, and still with a lot more volatility. In fact, the SPY now outperforms on a risk-adjusted basis by 50%. This is actually pretty striking because it is ranked as the second best fund over 20 years, which is really just attributable to 2 years of outperformance, which happened 17 years ago. So that just gives you an idea of how impactful a good year or two close to the reporting start date can be. We also take a quick look at monthly returns, which is an even better way to assess the average performance versus the benchmark because we have more data points. When the market is up, the strategy outperforms, and in the down months, it underperforms. On an absolute performance basis, it does outperform, but with much higher risk, and so on a risk-adjusted basis, the SPY actually does better. And so in conclusion, there is a lot more than meets the eye with equity curves, and outperformance in the early years can really distort the picture. It can be difficult for the average investor to assess based just on looking at the equity curves. So you really need to analyze the performance data to understand the strategy, and we have provided some of the metrics that we use. Thanks for watching.